Hopefully I'll be in a place where I can.
Well, good morning. Let's
Sit down and do the meeting, but a little bit.
And welcome to the Permanent School Fund Corporation's regular third quarter meeting. We do have a quorum present. And as a reminder to everyone, our mission is, as always, to provide permanent funding to Texas public schools by generating exceptional investment returns and to reduce borrowing costs for Texas schools and charter schools through the bond guarantee program. That's our mission. The decisions we make here in this room are intended to support the education of some 5.5 million young Texans in classrooms all across Texas, and to support the work of our 382,000 classroom teachers who work every day to teach those children. The Permanent School Fund accomplishes this mission not only with this team that we see represented here today, but in partnership with the School Land Board of the General Land Office to manage the land assets of the Permanent School Fund, led by our outstanding land commissioner, Dr. Don Buckingham. And so that's the mission and that's the work. And so our first item of business is the approval of the minutes of the May 14th meeting. Do I have a motion to approve the minutes?
Moved.
Motion from Dr. Ellis and a second.
Second.
Motion in a second. Any additions or corrections to the minutes? You know, they stand approved as read. So each meeting, then we receive an update from our CEO regarding the operations of the Permanent School Fund. And standing now in the batter's box is our esteemed CEO and CIO, Bob Borden. Mr. Borden, the floor is yours.
Thank you, Mr. Chairman. It's my pleasure to be here with you all today, and humbled to be the steward of the moment in this 200-year history, nearly, of this fund, and hopefully the work that we've been doing as a corporation here will change the trajectory of this fund for the next 200 years. We're quite pleased with the progress so far. Today, I will make my comments a little more compact than usual, but want to focus on our fund performance, some of the upcoming recommendations we see coming out of our work with the risk committee of the board and our internal risk committee, and give a general quarterly update of some of the activities and going-ons here. In terms of performance, we just continue to have an incredible tailwind in this seemingly unending economic expansion, driven primarily by AI in this country. We are once again setting record highs in the stock market as recently as a few days ago. Our performance of our fund on a 1, 3, 5-year and 10-year basis all exceed our board's policy benchmarks. And just as an update, this is 1 year versus policy as of 12/31, where we have all the benchmark data and policy data finalized. But as of June 30th, it's trailing 1 year about 11.4. I'll contrast that with our long-term expected rate of return of the portfolio that is somewhere in the, call it 6.5% range. So you can see that we have been exceeding our expectations significantly, and that is driven by this continued economic expansion in the U.S. When I look at the key drivers, we see GDP still increasing, and despite the fact that the stock market prices are going ever higher and higher, the earnings of the companies as they're releasing them are likewise in many cases meeting or exceeding expectations and seemingly supporting these very high valuations. If there's one thing that we've got our eye on, that could kind of be a wet blanket to this expansion, is inflation. Since COVID, we've seen the reemergence of inflation systematically for the first time in 40 years as supply chain constraints and other protectionist strategies amongst countries and restrictions of global trade have led to a lot more sensitivity to inflation. And the Fed is watching this very carefully. I think the consensus was few months back that there might be an easing accommodative policy, but the concern about inflation has led them to be very reticent to do anything to be stimulative. And indeed, we're seeing, higher long-term rates. The Fed, of course, only administers overnight lending rates amongst banks. The longer-term rates are set by the market and have been creeping up a little bit. Financing rates for all types of real estate is probably the headline, and slowing down expansion in the U.S. home market and other areas in the economy. But one area that seems to shrug that off, again, is AI and data centers and the hyperscalers are assuming that the growth and revenue and profits will far outweigh increased financing costs. We continue to see labor markets remain strong. And so these 3 out of 4 are good tailwinds that argue for still continued economic expansion. Now we're watching the inflation markers carefully, though, and we have spent a good bit of time assessing our overall concentration in AI-related investments, which now roughly represent about a third of the U.S. economy when you really take it all into account. So it is transformative what has occurred to our underlying economic basis. Pivoting to some of our activity and placements and our focus on Texas and emerging managers, as we've stated several times, in as much as Texas is, by various measures, the 7th, 8th, or 9th largest economy in the world, it stands to reason we would find a lot of opportunity here. And we indeed do. And we find that opportunity without compromising our due diligence standards and our screening process. But because of the wealth of the economy and success of the economy, we're able to have placed about 1/4 of our investments or end up being allocated to Texas headquartered firms or firms with significant economic presence in Texas. A couple of our larger relationships include DFA in Austin here, and to 2 energy juggernauts in NCAP and Quantum, which have performed exceedingly well for us and continue to be strategic partners of the first degree. I'm pleased to announce that one of our largest strategic partners in the private credit and private equity space, Apollo, has just announced that they are forming a second headquarters in Austin. And that is in no small part to the relationships that they have with the Permanent School Fund and other leading funds in this city. And I think that is a real bellwether to see that Austin is attracting, one of the top firms on Wall Street to set up shop here. I think that bodes well for others to perhaps take the same leap. A question was brought up at our last board meeting of how we are doing in also trying to see that we place money where warranted to emerging firms, small upcoming firms, or firms typically owned by historically underutilized minority groups and the like. And I'm happy to say that prior to the creation of the corporation, the PSF actually had an allocation, a set aside, if you will, of 1% of assets to emerging managers. We philosophically did not believe that belongs in the asset allocation mix. So we removed that from the asset allocation, but we have tripled the amount of emerging manager placements that we've actually done and quadrupled the average deal size that we have done. So it's much like the Texas First notion. We like to say that tie goes to the Texan. And we routinely find some very compelling and interesting emerging firms as well, and we continue to take advantage of that and help develop some of these firms to be the next leaders in asset management. terms of some of the work in our risk committees, I will say that we've spent the last 6 to 9 months implementing new risk management protocols and risk management modeling capabilities. The board had assigned to its planning and policy committee the additional responsibility of risk. And we focused heavily on 3 things: the liabilities of this fund, and our liquidity and leverage that used to service those liabilities. Our primary liability, as Chairman Maynard mentioned, is we're here to be a source of funds for the state. We're making record high distributions both in 5A and 5G that are really a direct offset to the tax burden on the entire state. So it's a very valuable function for us. And those payments, we have to make sure that we've got liquidity in place for. We also have to pay our operating expenses out of this trust. The budget for this enterprise is completely funded out of the trust. It does not rely on additional taxpayer allocations for its operations. But those numbers pale in comparison to our private equity commitments, our uncalled capital, which measures in several billions. And we've taken great pains to make sure that we have, under a variety of market conditions, including very draconian, great financial crisis type fall offs in the equity markets or stagflation type environments that we had in the 70s, that we will be able to meet all of our distribution obligations and all of our capital calls, and also be able to have dry powder to take advantage of opportunities in a dislocation. And we found that we have a significant coverage in that space quite comfortably. One thing that is likely to come out of this that we'll just telegraph today is to make sure that we've got the last piece of ability to conjure up liquidity in times of crisis. We will probably be suggesting to this board at its next meeting to consider raising its leverage limit that was just set for the first time ever in its investment policy at 10% to 15%, which better aligns with our peers here and gives us just a little bit more flexibility in times of crisis. The other area that the risk function of this corporation has been keeping an eye on is concentration risk. I've already mentioned probably half a dozen times AI as a real driver in our economy, but it's also become a very big concentration in our markets. The S&P 500 by various measures is in the high 30s to 40% now in a handful of names, 7 to 10 names. That type of concentration has not occurred since the internet bubble in late 99, 2000. So it bears close monitoring. There are things we are considering in possibly our index construction and our benchmarking of large cap equity that we will continue to study as ways to perhaps better manage around unintended concentrations that we find ourselves in today. But so far, those concentrations have paid off handsomely. So we're trying to take a look at this during the good times and plan for, how we might be able to pivot and manage this when inevitably, repricing events occur in any kind of economic cycle. And this one stands out as an extraordinary expansion. So I would not be surprised if the repricing of that comes with a good bit of volatility. But the question of when that may be triggered is open-ended, and it could be months from now, it could be years from now. But just suffice to say, this is a focus of risk management in the enterprise. Other operating highlights from the quarter, the PSF Corporation staff has been working closely with the Texas Education Agency in refining and updating the memorandum of understanding between the two enterprises, particularly as it relates to the bond guarantee program, and making sure that we've got a good feedback loop for pending issuances and credit rating impacts. I won't repeat, what I stated probably in 3 consecutive meetings last fall and earlier this year, but a great deal of effort was placed on understanding the implications of our growing BGP program and our evolving asset allocation as it relates to maintaining our AAA status. And we made significant headway working with the agencies to make sure we have a lot of headroom there. So that program is working well, but we're taking advantage of the opportunity to refine the coordination between these 2 agencies to make sure we're managing it as best we possibly can. Pleased to say that we had under one of our strategic goals is to attract and retain talent, and our recruiting function has reached out across the state to our many fine higher ed institutions in building our internship program. That internship program really, ramps up the energy and vitality of our daily efforts with folks that are on the cutting edge of learning new technologies and applications in the universities and bringing that to our investment program. It also forms a farm team of hiring permanent talent that has now been tested through an internship program, so we can ensure that the right cultural fit and job performance it warrants an opportunity full-time. We had our largest ever internship class of 18 interns, I think representing about 8 or 9 different universities in the state. We have 2 interns from the Macomb Success Scholars program at UT, which is a program that is designed for first-generation college students. So pleased to be able to be harvesting from that program. And additionally, 2 interns from the SEO career program for high achieving and underrepresented students as well. So we have a high amount of diversity around the state and from different socioeconomic backgrounds. All of these students have performed admirably, and we just concluded an all-hands review of the projects that were assigned to the 18 interns. I'll say about 12 to 15 of them are process improvements based on AI agent models that have been built to really streamline the operations here. So we've got some real talent that's adding a lot of value for very reasonable cost and making a difference in the state. Aside from these Macomb Success Scholars and the SEO Career Center, we also did go out of state for one Ivy League candidate, and I guess arguably within the Ivy League of the South, one from Rice. In terms of our retention of employees, we've focused a lot on wellness and well-being, and pleased to say that we were awarded the Mayor's Health and Wellbeing Council's Worksite Partner certification at a gold level. And some of the organizations, that have achieved that are things like Samsung and UT Austin. So we're in fine company in terms of how progressive we are being in establishing a culture of wellness in a healthy workplace. And that's not only, your typical, eat better and exercise more, but it is mental health awareness, heart health, and we're running health screening here and other beneficial programs such as immunizations and the like. Our AI usage internally has really mushroomed, not due in no small part to the value that interns have added, but we have almost a 9-fold increase in our AI usage over the last year, and really taking advantage of what have historically been lots of manual processes and lots of cutting and pasting of different, spreadsheets or applications that are now being automated. Very helpful. I'm pleased to say that we hosted this summer over 100 public school teachers for the FFA's lead teacher program. Chairman Maynard was a robust participant in that, I would say, with his background with the FFA and the leadership there. I don't know, Chairman Maynard, do you have a soundbite to add to that success of that meeting?
Well, I mean, I think anytime that we have an opportunity to present to educators and give educators a more fulsome understanding about how a lot of things happen in Texas, it's a good thing. And most teachers don't really know very much about the current school. And so I think it's a great opportunity, and Public School Fund is a real Texas treasure.
Right. So we intend to make that offer. I think they have a biannual or annual Mecca, to Austin, really to kind of prep for upcoming legislative sessions, and these school teachers are selected, because of their leadership skills and ability that they've demonstrated. So it's kind of the cream of the crop of teachers from across the state, and a great opportunity for us to, show in real terms, what we do for the K through 12 schools in this state. Last item under employee development is we have continued to expand our employee training and development program. We started earlier last year with the basics on technology training for all employees to make sure that we've level set technology skills and spreadsheets and presentation, where we've expanded that now to be AI applications therein. We had all the executive leadership has gone through series of executive coaching and professional development training, and we are now rolling that out to all the mid-level managers as well as developing a specialized supervisory training for first-time supervisors. So to make sure that as people grow in their career intellectually and take on more responsibilities, they are also being trained in, leadership skills, and making that, a programmatic feature across the organization. And with that, Mr. Chairman, that concludes my comments for today.
All right, board members, any questions for Bob? Sure, that's we're satisfied, or are they a stunned silence? I'm not sure. Well, excellent. Well, that's thank you, Bob. Yes.
We're having a pretty tough time hearing you on the phone here, or if you would adjust your mic, I think it would help, or whatever. Okay.
Noted.
Thank you.
Our technical team back there, can you address that?
Yes, sir.
Okay. Okay, Mr. Thomas, thank you for pointing that out. Thank you for that. Item 3, we're going to hear from our fiduciary council, and NEPC has been our fiduciary council for about 15 years, I believe. Maybe get it close to 16.
It's longer than 2008/9. So
Yeah, so
a bit.
yeah, so NEPC brings a third-party perspective for the board of directors, and also brings significant resources for our investment team. He's been with NEPC for 18 years, since 2008. And today he is joined by the head of NEPC's private equity team, Josh Beers, and I will let Keith further introduce Josh, because if you look at the agenda, our next thing up, we're going to be looking at private equity and indirect investments. And so NEPC has brought a heavy hitter, an expert. And so Keith, if you want to go ahead and bring your remarks and your observations.
Yeah, very good. So good morning. Thank you, Mr. Chair. So just high level, last time around, we reviewed private debt with Rhett and Colton, the investment team. Today we'll do a similar exercise with myself, Josh, that's the Aaron, and Andrew here from the D team. To Tom's point, we've been working with you all for quite a bit of time. I took some notes here. In 2008, there was a 6% target private equity, but we had little to no money in the ground. And 18-20 years later, we have a 20% target. I guess it's 10.5, 11 billion in the ground. We're starting to work in some IPOs, some public equity there. So a major accomplishment on that front. And today we're going to dig into sort of state of the market, what y'all been up to, what the returns look like, the value add that you've had over those 18+ years, and some exciting stuff that y'all are doing in sort of co-investments and direct investments in the IPO space. So I'll toss over to Josh, and then we'll kind of go back and forth on the state of the markets. And then next item up will be Aaron, Andrew, and the rest of the team.
Great. Thank you, Steve. Yep. Appreciate that. Good morning, Mr. Chairman. Good morning to those that are in the room and to those that are virtual. Nice to meet you all. I'm Josh Beers. As you heard, I head the private equity team, also a partner at NAPC. I've been investing in the space for just about 20 years. I started my career at an insurance company, investing off their balance sheet, doing both manager selection and direct investing with them. I did that for 10 years. That was Liberty Mutual. I like to say that I am not responsible for their marketing campaign. However, I'm sure the private equity portfolio at some point paid for it. So I guess in some indirect way, we would be responsible. Yes. And then I joined NAPC 8 years ago and became head of the team. So why are we here today talking about private equity? Well, first and foremost, it's a big piece of your portfolio. It has a target of 20%. The expectations of the asset class. So if you kind of look at the chart at the top here, is expected to outperform public markets by quite a bit. I will say that 8% performance comes from our asset allocation team. It's important to note that that does not necessarily take account for manager selection, which is really important. We'll get into some of those details in a little bit. And of course, with an asset class that's predicted to outperform public markets, it does come with its trade-offs. And those trade-offs is it's a very illiquid asset class, and it does come with volatility. With both of those as your trade-offs and risk to the asset class, the hope is longer term that you outperform it by quite a bit. So if we go to the next slide, we're going to dive into the market quite a bit. I'm going to spend the next 10 minutes sort of setting the stage for staff to talk about the private equity portfolio more specifically. But when we think about private equity, it's hard to talk about without talking about returns. And I'm sure you've read headlines. Expectations are that returns may not be as strong in the future as they had been in the past. Where that may be true, and I think there's some data points that may point to that, it's still an asset class that we expect, as you saw from the previous page, perform quite well and outperform the public markets. And we'll get into some of those details as to why I think the market's shaping up to be a pretty exciting time to be a capital provider versus not being. The punchline with this slide, and frankly, I'm going to spend just 1 second. I won't do this every slide, but when you take a look at the slides that I put together, you're going to see North American buyout at the top, and then you'll see the North American venture at the bottom for the most part. There's one slide in here that doesn't have that, but that's the logistics of these slides. The punchline with this slide is manager selection matters a lot. You just can't throw spaghetti at the wall and hope for great returns. You really have to do your work, have to get access to the best managers. So if you look at the dark blue line in both of these charts, that is your upper quartile managers. And then your light blue line is median. And one thing that is definitely being demonstrated today is that the dispersion of returns between, so the difference between that light blue line and that dark blue line are getting wider, and even wider when you look at that green line, which is your lower quartile. If we go to the next slide, oftentimes we compare it to public markets, because if you're going to lock up your capital, of course, you want to be able to do it in a way that's going to outperform public markets. And so what we have here is your dark blue is your buyout pooled returns versus the Russell 2. And your light blue line is venture pooled returns versus the Russell 2. So that is what we call a PME, or public market equivalent. And the real punchline here is buyouts in general, which is a good piece of your portfolio, have outperformed public markets on a very consistent basis. Even when you look at the downturn of between 2008 and 2009, it continued to an asset class that continued to perform quite well, albeit not at its peaks.
Is that compared to median or
so this is a pooled return.
Okay.
So it's all returns, versus the Russell two. If you were to take it, and do like quote manager selection, show upper quartile, the returns obviously look way better.
Right.
And the other thing, so you have
But it's
the,
still supporting, just generally speaking, we're getting the illiquidity risk premium.
correct.
That we assume that we're getting.
And then the only other thing that I'll point out on the venture side of things is, albeit a little bit more volatile than buyouts, but when it outperforms public markets, it does outperform it in quite a significant way, and even buyouts in general.
I think so this is through 15, right? Because the expected life is typically 10 years, but the last 3 years, S&P's been up 25, so you're not seeing a premium. So it's important to kind of preface what we're looking at there. But going forward, 10 years out, I think you'll see that premium again.
Yeah, and just that point, I think in fairness, since we cut it off in 2015, it's important to note that there is a lag in valuation performance when you look at private markets. And so when you have volatility or massive increases in the public markets, it takes a long time for that to flow to the private markets. And therefore, we like to look at older vintage years when we do this analysis versus more recent vintage
Yeah, I
years.
think in the case of the PSF, it's exacerbated even more because we significantly increased our target allocation. So we've been loading on a lot recently that's kind of still in some form of a J curve or something versus a public market that's just on fire. Straight out.
Yeah, I think
But we would expect.
over time, it should, yeah, we should see the premium.
Yep. Converges. Okay, if we go to the next slide, this is just fundraising in the market. And I think there's two really important things to point out here. And frankly, two of the most important things are probably the hardest things to see on this slide. So one is that gray background. That's what we call the overall overhang in the market. So that's it's capital that's been committed by LPs, but it's been yet to be put to work. So it still needs to be put to work. And as you've seen since 2016 in both of these asset classes, it's grown quite a bit, suggesting that a lot of LPs have entered the market. The other thing, and I think that the reason why I like to point that out is for the first time in, call it 15 years, I know this only goes back 10, but I can tell you for the first time in 15 years, it started to plateau and start to go down. That's really healthy for the market. That means that is working its way through the system, and more or less competition is those dollars of, think of it as competition, is starting to come out of the market. So that's really healthy. That'll be good for valuations, I would say longer term. The other really important thing, and then this really does speak to competition and why you're seeing that gray chart come down, is the dots. And that is the number of funds that are being raised in the market today. And as you can see, it's been at a steady decrease since its peak in 2002. Again, really healthy for the market. That is suggesting that managers that shouldn't be investing in private equity are finding it very difficult to raise capital, and therefore likely would go out of business. Again, sucking competition out of the market, which again is a very healthy thing, much longer term. If we go to the next slide, we talk about just deal activity in general. Since its real peak in kind of 2001, we've seen it come down. 2025, we saw our capital money get put to work. And that is a product of funds that when capital is raised within these funds, they have about a 5-year period in which they have to put money to work. And so if they raise capital, if you look at from the previous chart, if you remember, we don't have to go back, but if you remember, you had vintage years that had raised capital in 2022 and 2021, peak vintage years of capital raised. Those funds needed to put that money to work, and they started to deploy that in 2025. So you saw a spike in 2025. But in general, everything's been coming down. Largely speaking, the reason for this dynamic is there is a bid-ask spread difference in the market. So what people are willing to pay for assets and what people are willing to sell assets are, they're just not meeting in the middle. You have managers that have overpaid for companies and they're looking for a return for their investors. And then you have the buyers on the other side that don't want to catch a falling knife. And so they're being very thoughtful with their diligence, and it's just more or less locked up the overall market. I want you to remember this slide because it's going to be really important when we talk about valuations, which is our next topic. So if we go to the next slide. As you can see, valuations have held pretty steady post 2022, both in the largely speaking in the buyout in the buyout space. And we're going to talk about venture in a second because I think that's going to take a few minutes to describe. But in the buyout space, if you remember the previous slide, transaction volumes are down. And so even though they've held steady, this suggests one thing to us, that A quality assets are trading today. It's not the B quality, it's not the C quality assets, and therefore pricing has remained very stable. So think of it as pricing stable on A quality assets, but you don't have the population that you've had in the past to really quote support these median valuations, if you will. And so our expectation is that as those B and C quality assets move through the market, expect these multiples to start to compress a little bit. Now, if you look on the venture side, if you remember, I remember quite distinctly because I was on the phone over the weekend with many of our clients because there was a lot of concern when SVB went under, and there was a lot of concern around the venture market. And so you saw a little bit of a flattening in the kind of the 2024 timeframe. And so you saw that flattening, then all of a sudden you're seeing it skyrocket today. And part of that skyrocketing, I think, is, I know is caught up in this AI wave. So there's a lot of capital flowing into AI. There's also a tremendous amount of capital that flowed into SpaceX, Anthropic, OpenAI. And so that kind of orange line, if you will, is largely being driven by some very big assets that are gearing up to go public. And I think there's going to be some discussion on that in a little bit. Now, our guidance to clients, and as we think about venture, is finding pockets of opportunity in which you can drive returns. And so I think there's places to play each of these markets. But as you can see, largely speaking, at the earlier stages, they tend to hold a little bit more steady than the later stages. And a lot of that has to do with duration of capital and again, these later rounds pricing quite high. And if we go to our last slide, it's hard to talk about private equity without talking about the public markets and exits in general. And so exit activity certainly has picked up. So we saw it pick up in 2025. Again, a lot of that is M&A activity. So it's larger financial institutions trading assets back and forth. And a lot of that is the A quality assets that are being traded. So you saw it pick up in 2025, 2026, as expected, and as we were expecting, a drop. And then if you look at venture, it kind of jumps off the chart. We're like, oh, wow, that's pretty impressive. It is, but I will say, largely speaking, all of that IPO activity was due to one company called SpaceX. And so where there are several companies that are gearing up to go public, so think of the Anthropics, the OpenAIs, and SpaceX kind of clearing the way for those companies to do that. There is a large backlog of companies that are expected to go, quote, I'm going to put that in quotes, expected to go public. Frankly, this is what we're hearing on the street from the bankers. There's about 100 companies that have filed their S1s. About, call it 40 of them are likely viable public companies. And so there is going to be a bit of a drop off rate. I know there's a lot of expectation, a lot of pent up demand for liquidity. Our expectations and our guidance is liquidity is coming, but it's going to take a little bit of time for it to work through the system. I will pause there. I know that was a lot of information, but happy to answer any questions or get deeper into any topics.
All right. Board members, any questions?
Aaron has a thing raised. Aaron's got a thing.
Mr. Kinsey.
Hey, good morning. Thank you for the presentation. Speaking about these exits, there's been a lot in the press lately about zombie funds. I wondered if you might comment about that and just generally. And then our exposure to that phenomenon as the PSF?
Yeah. It's thank you, Aaron, for the question. Zombie fund, so the way they're describing zombie funds is in the biospace in particular. I think there was a Financial Times article, probably the one that you may be referencing it, Aaron, around the amount of private equity companies that are private today that need to get liquid has almost doubled over the last several years. So it's gone from something like 15,000 to 30,000. And it brings up this concept of zombie funds. And so if you remember when we're talking about fundraising, the number of funds that are getting raised today are going down. And so what happens is managers are finding it difficult to raise capital, but they still have active companies that they need to liquidate. What happens to those companies? And those are, quote, the zombie funds. Less concerned, and I'll also let staff weigh in on this as well, but I would say in general, knowing your portfolio, I would say I'm a little less concerned about the exposure to those zombie funds. It comes down to manager selection. It goes back to kind of my beginning comments around making sure that you spend the time diligencing and finding those top quartile managers. Typically speaking, although performance can vary, typically speaking, those managers have the talent, the teams to be able to execute no matter what environment that you're in. And so those tend to be the groups that can not become, quote, the zombie funds. And so guidance going forward, and I want to be careful on how I use this phrase because when we were talking earlier about emerging managers, I don't mean it in the context in which it was being discussed earlier. But when we think of first-time fund managers, probably a better way of describing it, there's a lot of caution that we're giving both clients and what I'm giving my team today is because there's one thing for sure in private equity. You do not get paid, meaning you don't get paid for the risk that you would be taking to invest in a manager that has fundraise risk. You can never factor that in. And so we're very cautious about these first-time fund managers today. And again, I think those are the more likely groups that would become the future zombie funds, if you will.
So if I can weigh in on that as well for the PSF, because of the age of our portfolio, we really only started investing in private equity in 2010, right? And commitments have ramped up in more recent years, but we are really only now starting to reach the end of fund life in kind of some of our portfolio. The majority of our portfolio is still either actively investing or harvesting. So we're not really yet at the point where we're starting to see funds in our own portfolio just extend and extend and extend. But we do spend a lot of time upfront in the legal process working on fee structures and extension terms and making sure that we don't find ourselves in any kind of trapped position when we do get to the end of a fund life, in order to prevent, again, being stuck in funds that are not selling down and just continuing to charge us fees. So it's something that we're not necessarily seeing move through our portfolio yet, but we are certainly highly aware and engaged on kind of the funds approaching the end of their life.
Jump, if I may. Are continuation vehicles in there? And if not, kind of explain that. That's sort of the consideration of how we are seeing some exits out there since sort of the markets are locked up a little bit.
Yeah. So continuation vehicles are being captured in these numbers. So just for the benefit of those that may not know what a continuation vehicle, it's basically a vehicle that the manager creates with typically with a secondary fund manager that creates a separate vehicle that takes their A quality assets, rolls it into this vehicle. It provides liquidity to their existing LPs. Continuation vehicles have been around since the 80s. They are very much being more utilized today than they have been in the last 15 years. I will tell you, it's an interesting dynamic that they're creating in the market today because typically groups like yourselves, in general, LPs hire groups that are LP allocators at the end of the day. They're very good at allocating to funds, but they may not be necessarily good at evaluating single assets. So GPs overnight have asked the dynamics to change in the marketplace. I can tell you, when we think about continuation vehicles, we very much think of it as a quote co-investment, and we do a lot of work for our clients to make the decision whether to roll or sell those assets. But typically speaking, I would say more times than not, most LPs are taking the liquidity event because these funds tend to be a little bit longer in life, and taking that liquidity and redeploying it in high conviction managers is typically the path that these LPs are taking.
Okay. Mr. Hickman.
I think it's slide 17, where you show the risk forecast and the return forecast. Is comparing global equity, US core bond, private equity. I understand the return forecast. Can you just, what is the risk forecast at 18.3, 5.7, 26.7? What does that mean?
Yeah. So it's basically the volatility that you would expect within those markets. So the higher the number, the more volatility that you would expect. So basically things going to zero or going down or going up.
Kind of that 18.3 global equity, is that like plus or minus 18.3% within one standard deviation, something?
Exactly.
Okay.
Yeah.
I guess two standard.
Further out you go, the more confidence you have.
Okay, great. Thank you.
And even the private equity, I would argue that we're much higher than realized. Your volatility is probably a lot lower than that, just because of the quarterly lag and the way things price there. It's probably closer to mid-teens at that point.
Okay. Any further questions?
And bonds these days are a lot more volatile if you follow the markets.
All right. Any further questions for NEPC? We appreciate you, and we're going to kind of continue this discussion, because what we're going to do now is we're going to move into our private equity and direct investment portfolio. And so, and keep in mind that this is one of 12 different asset classes, and comprises about 20% of the portfolio. And I'm going to call on our Deputy Chief Investment Officer, Stu Bohart, further introduce the item. By the way, I'm always continually amazed with the talent that we have here. Stu started his career with Harvard Endowment Corporation and was president of Morgan Stanley Asset Management before joining us. And so I think we've really got a top flight team. And Stu, why don't you set up the review, and we've got a big picture here. Now, let's talk a little bit about what that looks like here at the PSF.
Thank you, Chairman Maynard, and Josh, thanks for the setup. That's terrific. It's an honor to be here. I had a long career on Wall Street, and my woke daughters tell me that I'm finally doing something worthwhile for the world. So it's a pleasure to be here and support public education. Just on a high level, so you understand how PE fits in. Remember, we've got an endowment style portfolio. That means a very diverse portfolio, diverse across asset classes, 12 asset classes, diverse across risk profiles, right? We're paid to take risk, and we need to take risk, and I'll cover that. And diverse across liquidity profiles, from less liquid to more liquid. Private equity falls into less liquid, not fully illiquid, right? Things do move, money does come out, you can sell LP stakes, but certainly less liquid. Our goal in this portfolio, real returns, right? Inflation rate, which we need to preserve for future generation school children. When we're above the inflation rate, we create money that can be distributed to the current school children. So real returns are important, right? To the extent we pound out real returns of 4 or 5%, we succeed in having annual distributions that are growing and meaningful to the taxpayers and meaningful to the school system. So our endowment style portfolio is designed over a market cycle to generate those real returns across all these asset classes, some of which may do well in a year, some won't, across different liquidity styles. The liquidity style is important. We are in a unique position, $60 billion permanent capital pool with no liabilities. Right? That's unusual. That's classic endowment. That's not like a pension fund that has liabilities, maybe underfunded. We are by definition fully funded. If we do a good job, we make our distributions each year. So we can take liquidity risk when it makes sense to do so. And makes sense means we get paid to do so. Private equity is an important part of taking some liquidity risk as part of this highly diverse portfolio. And as an example of this, our unique structure, our permanent capital, our lack of liabilities, our AAA rating, Josh mentioned in the private equity world that capital raising is tough, right? There haven't been a lot of distributions. We have capital. It means we can drive a very hard bargain, right? It's nearly impossible with new funds. So when we see new funds, we're not interested in a fund that's just showing up at the party and saying, I want to be in private equity. We're interested in funds that have unique skills in interesting segments, and we can drive a very hard bargain there as well. So we have advantages because of who we are in this space. The style or our focus in everything we do is to be great at manager selection. And I think Josh covered how important that is. That is how we beat our benchmarks, by being superior at manager selection. And second, by co-investing next to those managers when it makes sense to do so. And so we'll cover both of that in our private equity book, 20% of this diversified endowment style portfolio. How do we choose great managers? What are our results in doing that? You'll see evidence that we're good at this. How do we co-invest next to them? And then lastly, the IPO market. How do we take advantage of companies that are coming out of our private equity investments? And how do we take advantage of our footprint? And what is a great name in investing, a permanent school fund, permanent capital? We can be great long-term investors with many companies. So with that, I will pass it to Aaron and
Good morning.
forward to hear your pitch.
Good morning, everyone. Thank you for having me today, and thank you to Josh, to Keith, to Stu for those comments. Today, I'd like to provide an overview of our private equity program. We'll talk about our team and some recent performance. We'll also discuss the macro and PE market factors in a little bit more detail that we think are providing headwinds, but also we hope for potential opportunities. And then we can talk about where we're spending our time going forward. At the beginning of the year, we bifurcated our PE program into two separate components, buyout and growth and venture capital. And each of those asset classes now has a dedicated allocation target and benchmark. The majority of our portfolio is buyout and growth, and it is performing its benchmark over the 3, 5, and 10-year periods. Over this past year, as Stu mentioned, we've really been leaning in and more fully leveraging our GP relationships. We've done that for IPO allocations with our equity capital markets initiative. And I'll introduce you to Andrew for a brief overview of that program. We'll also have Chris Eckerman provide an update on our internal co-investment build out, both team and process. On the team, my name is Erin Wiedepol. I lead the private equity team, and I've been with the fund since 2012 when I joined from Common Fund Capital. We haven't had any changes to the senior level of the team since we spoke last year. We count on 2 assistant vice presidents, Marty Telfer and Joe Rest, and 2 senior investment officers, Jewel Chen and Tyler DeBose. Tim Williams is an investment officer. Japraj Singh was our newest joiner when we spoke last August, and he's now been on the team for over a year. One new addition to the team is Xander Laros. Xander joined us after his internship this past summer and fall. And so, as Bob mentioned, our revamped internship program is really continuing to pay dividends. We also rely on the newly formed co-investment team. Chris Eckerman joined in late 2025. Aaron Aguirre moved over from the PE team to work with Chris. And then below them, you see Andrew Bunker, our head of capital markets. Moving to the PE program, we are at our target allocation when you do include the liquid substitute. You may remember that liquid sleeve is going to continue to shrink over time as commitments to our buyout and venture capital programs draw down over time. So that's a bit of a buffer for us to use for capital calls. Within the private portfolios, our buyout allocation is just below 16%. That's that 15.9% current allocation versus its policy target of 17%. And venture is at 2.7 versus a target of 3%. So all in, that's 18.6%, which I think is a little bit ahead of pace where we thought we might be as we work through this 15 to 20% increase in our allocation. And so as Bob mentioned, we do have a healthy amount of committed dollars that are waiting to be put into the ground in service of achieving that target of 20. And so for those two private portfolios in aggregate, we are currently 3/4 North America or global focused, and global does tend to be US and Europe in and of itself. Our venture book, as you might expect, is primarily technology, but we've more recently focused our buyout activity less on software and more in the industrial space where we think there are more meaningful value add opportunities. Overall, we believe we have a pretty well diversified portfolio, and we'll continue working on optimizing portfolio construction as we do approach that target allocation. Here I'll spend a little bit of time on our performance for those two underlying components of our portfolio, buyout and venture. So just orienting you to this chart, the different colored bars represent the PSF performance, time-weighted return over 1, 3, 5, and 10-year periods, moving left to right. And the yellow dash is going to be the benchmark for each of those respective time periods. On the far left, we have our total private equity portfolio. As a whole, it's outperformed the benchmark in the 5 and 10-year periods. And this is driven by really meaningful long-term outperformance in our buyout and growth portfolio, which is that section in the middle. Our buyout strategies represent about 85% of the portfolio by NAV or net asset value. And in the long term, the buyout portfolio is outperforming the 5 and 10-year benchmarks by over 200 basis points. And so this is what we would really hope and expect to see in a long-dated asset class. Venture on the far right has been more challenging. We've definitely seen market movement on our 1-year time-weighted return, but you can see that the benchmark is also running well ahead of historical norms. We've talked about this a bit in prior comments, but the venture markets are being driven right now by some very mega rounds in the AI space. We do have some more recent AI exposure that's performing well. We think we admittedly missed a good amount of maybe the first round of AI hypergrowth, but we do think this is a theme that is going to persist. And so right now we're really trying to balance participation in the next generation of AI-enabled companies, but still being super cognizant of the very high valuation environment that we see in the space. On the commingled fund front, we do again focus the majority of our time on the buyout portfolio. We have a tilt towards mid-cap buyout, primarily in the US and Europe. We've developed several strategic partnerships with firms of scale, and this has been helping drive our co-investment deal flow. Given the performance challenges I mentioned in venture, we are restructuring that team. We're looking to hire a dedicated professional to capitalize on what really are more unique networks and ecosystems in that space. And we'll expect to reset the go-forward strategy with their guidance. We do still believe that early stage funds present the opportunity for meaningful outsized returns, but we know that we need to better capture the upside in the most successful opportunities. Yeah.
You mentioned strategic partnerships, and I just want to emphasize their importance to us. Manager selection matters, and because of our size and structure, we're in a unique position to have strategic partners that can work with us across the firm. This is a technique pioneered by Bob Warden at South Carolina in working with external managers across asset classes and styles to truly partner in launching new product, in investing in co-invest, and doing innovative things where permanent capital can be highly valuable. And it's played a particularly important role in private equity as we generate more returns around co-invest, and you'll hear from that in a second.
Thank you. So we do believe our portfolio is well positioned to weather challenges in what has been a somewhat difficult market. One of the things we're keeping an eye on is the exit environment. We chatted about that a bit earlier. But across the industry, distributions are not keeping pace with historical averages. Company hold periods continue to extend, and managers that may have overpaid or over-levered are kind of waiting for their businesses to grow into those valuations. And so the lack of distributions does make it difficult to continue funding new investments at the same pace, but we do find ourselves in a fortunate position in that we are still slightly under target and we're less capital constrained than I think some of our peers. Nonetheless, we are highly focused on our pacing and our forward pipeline, and we're just trying to be super selective about where we put those new dollars to work. The software market correction was driving headlines in private debt earlier this year, but that's going to lead to some spillover on the PE side as well. PE seeing the impact of declining valuations in this space as businesses come to terms with the potential impacts of AI on that industry. So that's something that we're watching, but we're also hopeful that we may see opportunities for our sector specialists in that space. AI valuations. Oh, sorry. Yeah. Thank you. AI valuations, as we discussed, of course, present a challenge. Those companies are spiking in value and driving up the benchmark. We've taken steps to prudently add some late-stage exposure to our venture book, but again, an area to watch. And retail capital is another area we're keeping an eye on. A flood of retail capital into private equity has implications for fundraising, for co-investment flow, and just the general balance of power that institutional investors like ourselves hold. All of this is not to say that we don't see opportunities. In traditional buyout, we believe operational value creation is as important as ever, and we believe domain expertise matters. At the end of the day, there will be a market for well-run, high-quality assets, those A-quality assets that we talked about earlier. And our aim is to invest in managers that have the capability to build them in any market. We do participate opportunistically in secondaries, both LP and GP led. Those are those CV funds that Josh mentioned. We think an active secondaries program can help us take advantage of dislocation and potentially provide liquidity when others can't. We're actively focused on being a good partner across the life cycle of a private equity company. At investment, that might be via co-investment, and at exit, that might be via IPO. And so I'd like to turn to Andrew now for a little bit more color on that equity capital markets program.
Thank you, Erin. You want to hit the next slide? So one area that we're seeing additional pockets of opportunity are in highly adjacent public markets, and that's specifically in equity capital market transactions. And the way that this strategy intersects our private equity program is when we have underlying private portfolio companies that are in our private equity investment vehicles, when they get large enough, mature enough, and need to access public market capital, they'll structure that via an IPO or an initial public offering. Because we are a large institutional investor, we're able to participate in the IPO transaction and buy additional shares in these underlying portfolio companies, and we can do that at the offer price. The IPO offer price is typically structured to have an embedded discount in the price relative to where those securities are going to trade in the open market. And so the strategy really attempts to capture, monetize, and retain that discount for the fund as an additional source of value add for the private equity program. A little bit about sourcing and underwriting. So we really think about sourcing the investments from two main buckets. First, and the most important source is existing core private equity GPs. So these are managers that we're already invested with, running money for us. We're invested in their funds. We may also own the underlying portfolio company in those private equity funds themselves. And so we know the company well, we know the manager well. The second source is more opportunistic. This may be contacts through investment banks, whether that's on the equity capital market desk or through the sales and trading teams on the syndicate side. These can also come in through third-party managers that we're not necessarily doing business with today, but have done business with in the past, or we are a prospect for those particular managers. We may have dialogue about a portfolio company that they're sponsoring for an IPO, and we're able to source the investment that way. And so we'll selectively underwrite opportunities from either one of these buckets. We've depicted on the right-hand side here over the next 6 to 12 months, we think there's something between 40 and 50 interesting private companies that are either in IPO registration today or are getting very close to IPO registration. And so we've broken these out by sponsor type. Roughly half of these names are coming out of traditional private, like buyout, traditional private equity. Big chunk of the other half are coming from venture capital style private equity firms. And then there's a small sliver that don't necessarily have a financial or private equity sponsor. Those are more traditional corporate backed style IPOs. So we really think about the strategy as a company life cycle investing, where our internal private equity team, our private equity GPs are adding value in the private market space. As those portfolio companies mature and need to access the public markets, we're there to support that transition and support the IPO transaction. And we're hoping that adds additional source of value for the fund. And running these two strategies together, we think are highly accretive, where the underlying private equity portfolio companies are really a pipeline for the equity capital market strategy. And we're in a good spot to benefit from that overlap. I'll pause there, and then I'll kick it over to Chris, who can talk about the co-investment and direct program to build out that he's working with.
Thanks, Andrew. So I joined a little over 8 months ago, after having spent more than 10 years at the State of Wisconsin Investment Board, or SWIB. Although I'm no stranger to Austin, having received a BBA and MBA from the University of Texas. I've got broad experience across private markets with a strong background in direct investing, including in venture and growth. I established SWIB's PE co-invest program and oversaw its growth to a roughly $4 billion portfolio. If we look at this slide, this really lays out our overall approach. PSF has been an active co-investor. What we're really trying to do is formalize and iterate on those processes and what we've been doing. Today, we're going to focus primarily talking about private equity co-investment. And if you look over towards the right of the slide, historically, we've outsourced PE co-investments to advisors. We still have 2 of those relationships today. Within the internal program, we're really focused on a select group of core partners. These are managers that we have strong relationships with, institutional knowledge, and a deep understanding of their investment processes, judgment, and portfolio construction. We'll also selectively evaluate opportunities alongside groups that aren't in the portfolio. We view co-investment as a powerful tool for getting to know a manager. So this slide lays out how we're thinking about the internal build out of the program. Again, we're talking about PE co-invest today, but the program is an asset class overlay. So these principles apply to all of the asset groups as we seek to operate from a common framework. The design principles are pretty straightforward. The program needs to be integrated, selective, disciplined, and scalable. We will partner with the asset teams so that we can leverage institutional knowledge and domain expertise. The objective of this internal program is to support higher conviction deployment, lower blended fee burden through fee-free or low-fee co-invest, stronger strategic access with our GP relationships, and better management market intelligence across our private markets portfolios. Additionally, we believe co-investments enhance our GP relationships by providing firsthand visibility into how managers execute. Next slide, please. The middle of the slide shows some of the activity metrics, but what I'd like to emphasize is success is not merely measured by how we deploy capital. Over the first 8 months, we've made meaningful progress on a number of key elements of the program. The governance framework has been enhanced. We've improved cross-asset collaboration. We've implemented a standardized underwriting process. refined the legal and execution infrastructure, and we're actively sourcing across our core GPs. Importantly, these figures are meant to represent a selective funnel. A relatively small percentage of reviewed opportunities are ultimately approved, which is consistent with our disciplined approach that we're trying to maintain. As we approach strategic targets, capital becomes increasingly competitive across all opportunities, with only the highest conviction investments prevailing. Ultimately, the longer term objective is to ensure that the co-investments are a durable institutional capability that enhances returns, strengthens relationships, and improves the overall construction of the private markets portfolios. I'll pause for any questions. Otherwise, I'll turn it back over to Aaron for some closing comments.
Yeah, that ratio, get 252 pitches, right? You know, and you prove 18, that's kind of pretty consistent with across all asset classes, isn't it?
Yes, sir.
It's a bit of a gauntlet,
Yes.
but there's a lot of people out there fishing.
There's no shortage of opportunities, that's for sure.
Yeah, sure. Board members, questions before we wrap? Anything in the? Yeah, are you good? Okay.
So I just had a few key points I wanted to leave everyone with from today. One is that we are seeing sustained buyout outperformance over the long term. We believe we've achieved this via our prudent portfolio construction across those deep GP partnerships. We believe, of course, that manager selection is key. I think we've hit on that once or twice, and we do aim to continue this outperformance. We're repositioning our venture capital portfolio. We still believe there is opportunity to create a meaningful contribution to performance out of that book. We're scaling our internal co-investment program, lowering our fee basis and enhancing our net returns. And then again, lastly, we do have strong relationships with high conviction managers, and we're leveraging these across funds, co-investments, and equity capital markets. So we thank you all very much for your time and attention today. Appreciate it.
Thank you for that. Josh, any observations? You've kind of seen this, Keith, you and Josh have kind of seen this thing develop over time. Any observations that you'd like to share with the board just in terms of where we are?
Yeah, I mean, we were talking about earlier today about the co-investments and the direction you all are and relative to some of the other peer groups out there. So you want to hit on that?
Yeah, groups at your size are definitely active in the co-investment space. As you heard, Schwab certainly has been for a long time. And I do think that for portfolio the size of yours, it makes a lot of sense to build a program out there. I also agree that there's a lot of opportunity to get exposure to some of these bigger potential IPO candidates that getting access at the kind of private stage gets you potentially a lower entry point and therefore can take advantage of that as well. So I guess heading in the right direction makes a lot of sense to me.
And can you elaborate a little bit on the venture challenges you've had over in the venture piece of that?
We've historically focused on very small funds, some of which you'd probably classify as, more emerging teams that maybe hadn't run a fund before. We also, under prior leadership, focused a fair bit on Asia and China in our venture book. And some of those smaller funds have panned out. Not all of them have. We've really seen some struggles in the Asia portion of the portfolio. And what we're finding now is that our focus more deliberately on the very small end of the market is not giving us access to the bigger companies that are driving the market today. And so we think we really do need a reset, whether it's more of a core satellite approach or otherwise folding in some of this late stage exposure a little bit more deliberately. It just had been a fairly ad hoc portfolio, honestly, and I think we need a little bit more strategy and structure around the manager selection.
Let me add something to that. So someone asked once, is it too late on venture? And the answer is no, it's not too late. The world evolves, the economies evolve. Right in Texas, evolution is remarkable. PSF has been around 180 years, and God willing, will be around another 180 years. So it's never too late. We see a lot of innovation coming. You look at the pace of innovation over the last 40 or 50 years, and we've got a long runway. So we see real opportunity in venture if done right. We also see an impact on venture across everything else we do, right? Understanding where the world's going, what venture is doing, how that impacts our more traditional portfolios, even how it impacts our traditional core fixed income and credit portfolios. So it's a key element. What is different now is really what this board and the SBOE and GLO have enabled as a special purpose corporation. We are viewed as serious investors now. Right? People come to a nice office, they see highly skilled people, they see excellent returns. They see in Bob Gordon, a leader who's been in this space before and is able to execute. We see tremendous deals coming. In the past, those just didn't find the PSF. Right? The great deals went elsewhere. The people that could make a decision, evaluate and execute. We are now drawing those deals. We have to do the work, 252 to 18 to find the right ones, but they're at least ringing the doorbell now. And that will be true in both venture and co-invest. And so, we don't have to get this done over a year or 3 years or 5 years. We need to be in the venture space because it informs us broadly and because there will be real opportunities for us. And the managers will want to see us, permanent school fund, permanent capital that supports public education. We are a terrific investor for that.
A couple of questions. I think it's slide 33, buyout and growth, venture capital, private equity, liquid substitute. Can you just explain kind of what those three flavors are? And let me know if I need to stay after class.
The buyout and growth are going to be more your standard, what you think about PE, right? Control investments, majority or significant minority ownership by the GP, where they're really focused on executing more of a value creation plan, improving and growing those companies for sale, either to another financial sponsor or for exit in the public markets, as Andrew mentioned. The venture portfolio is going to be your startup companies, your high growth potential investments that are a little bit riskier, maybe a little less proven. They can do really, really well if they work out, but there's still a pretty significant chance that they don't. The liquid substitute is a bit of a buffer for us to move from the 15% to the 20% allocation. We invest that majority in the Russell 2000. It's going to be somewhat of a proxy for private equity performance. Granted, what the public markets have done over the last year has not been quite what we expected them to do, for better or worse. But we have it invested in the Russell 2000, and then we can draw that down over time as our more traditional private funds call capital from us. So we're expecting that liquid substitute to eventually shrink and go away over time, and that equivalent allocation will then show up in the venture capital and the buyout portfolios. Is that helpful?
That's perfect. Thank you. And then on I think the biggest one, buyout and growth.
Mhm.
Can you talk about return of capital? How long does that take? And if you spread it out among enough, then you'll have kind of ratable. Is that the goal?
The goal is to eventually self-fund, yes. As our allocation has increased, we are putting more dollars out the door than we're getting back. And that's exacerbated by the fact that the distribution market has been more challenging, as we discussed. So right now we do, let's say if our contributions are somewhat over $1 billion this year and distributions might be 3/4 of that, right? It's still coming back, but not to the extent that we can fund our capital calls 1-to-1 with distributions. The end goal is that we do get there. Historically, you would start to see money back from these PE funds in the 5 to 6 year, time frame. As we've talked about with the markets, that's definitely extending into 7, 8, 9 years. So it's slowed down. We are hoping that exit market will unlock at some point and we'll start to see that balance out. But for now, the distributions are a little bit below the calls.
And last one, I don't know if this is for you, Bob. You had mentioned a 27% number on AI, kind of, I don't know what you call it, concentration. On the next page, it talks about 25% in IT. Does that 25% go into the 27?
Yeah, those are
Is that how you
roughly
count?
equivalent, yeah. the equivalent of technology and AI, the technology being dominated by AI right now. But those are almost interchangeable terminology right there.
Okay.
A couple of things to highlight on, expand on Aaron's answer to. All of these private placements where we're making commitments that are drawn down over time and then you're waiting on distributions to come back. It's a bit of an accordion and, there are cycles in which the capital calls accelerate and the distributions decelerate and you're kind of at net cash out. But as programs mature and as exit markets are robust, the opposite can occur. You start getting cash back faster than you can redeploy it. We see that right now in some of our infrastructure space, commodities and related private equity investments up and down the supply chain have been red hot. And we're getting great returns and distributions, but they're coming back so fast, you got to replace those commitments. So we're kind of, we're really scrambling to make sure we can find the top best in class folks to redeploy with, but to keep that money at work. But when we look at projecting this sort of long period of time, we see all of these private programs as essentially stabilizing to self-funding. Roughly speaking, the distributions are equaling the capital calls, but there is cyclicality to that. And that's what we're taking into account with this whole liabilities, liquidity, and leverage exercise, such that when those imbalances occur, can you accommodate them? And we think we've got more than adequate headroom to do that. The other thing I might add in terms of recruiting and building out talent, venture capital and co-investment spaces are probably the biggest area of new talent that you would expect us to be making hires in the next 2-3 years in investments. That will be the focus because of all the economic potential in it, but the fact that we have to have the bandwidth to underwrite.
Thank you. Last one quick is, are the distributions mainly sales and IPOs or are there any kind of dividends or coupon like?
In the private credit space, you get a lot of it that's cash from the, coupons and the like. So private credit tends to be deployed faster and then tends to come back a lot faster because you're getting immediate cash flows and then there's a maturity. But in private equity, it's almost exclusively realizations from sales.
Okay, great. Thank you. Thank you, Chair.
Any other questions? Members? All right. So remember, this is an exercise we go through because we want you to understand the health of the portfolio, what we're doing and that sort of thing. And make sure that you kind of got your mind wrapped around things.
Mr. Chairman, as we'll see later, this also constitutes education credits for the board.
Oh, very good.
Right?
Yes. Okay, we've got some decisions to make. And so the first one we're going to work on is the 5G distribution. We throw that term around. The Texas Constitution, Article 7, Section 5 addresses the permanent school fund and its distribution. Now, Section 5A prescribes the distribution made by the State Board of Education. Subsection 5G is a supplemental distribution made from revenue derived from the permanent school fund land managed by the General Land Office under the leadership of our land commissioner, Dr. Don Buckingham. And it is my understanding that the revenues managed by the General Land Office have been excellent this year. And so before we proceed into that, we would like to kind of have a brief update on the good work of Commissioner Buckingham and her team. Jennifer Jones is the chief clerk and is authorized by statute to function as the land commissioner in the absence of the land commissioner. And so if Jennifer Jones is here and the land commissioner is not, you just think of her as the land commissioner.
Definitely
Yes.
stand in.
So can we call you, I don't guess we can call you
No.
Commissioner, Jennifer.
No, absolutely
But
not.
that's.
Jennifer's fine.
But if we can get there's some great work over there we'd like to hear about. That.
Absolutely. No, it's certainly been an exceptional year for the GLO and the revenues that we're bringing in to transfer in, for, certainly for the PSF, but ultimately the school children of Texas, as we all talk about. And in FY25, last year, we transferred 845.6 million, and we're expecting for the FY26 to nearly double that amount that will come over. Through July, we've transferred about 1.3 billion already, and are projecting that 26 total is going to end up being about 1.5 billion, sorry. Millions, billions, yes, doubling. And we've certainly benefited as well as y'all, from the favorable markets. But we have an outstanding asset management team that was well positioned to capitalize on those markets and generate those revenues with what the investments we have in the school land board, what they have done, and maximize that value. And so wanted to talk about the school land board also met earlier this week, and we presented these results and findings in the revenues generation to them. And based on the strength of those revenues, they adopted staff's recommendation to keep the revenues working for the PSF by transferring the full amount that's available when we come to the close of the fiscal year over to corporation for that distribution. We think, this approach puts those dollars where the most good can be done with them. And it gives this corporation the flexibility to determine how to distribute those funds to maximize those revenues even more. And Mr. Chairman, thank you for allowing that. That's basically just our quick overview.
Well, more people need to know that. And think about permanent school fund, it is not only what we do here, but it's also what is being executed over at the general land office, because when you look at the Constitution, that's what it is the permanent school fund is not only the assets managed here in the corporation, but also the land assets and all the royalties and all that goes over there. So it's a partnership. It's a team effort that we do for the school children of Texas. And so thank you for the good work, Jeff and everyone that's here. And thank you for the good work that y'all do over at the general land office. And please, pass our compliments to the land commissioner like that. And so
We appreciate the partnership very much.
all right. So today then we will make a decision on the 5G distribution, which is constitutionally capped at $600 million per fiscal year, 1.2 per biennium. Now, anything that is in excess of that comes back into the corpus and helps to grow the corpus, which helps grow the other part of the distribution, which is 5A. And so Jared, our Senior Vice President and Deputy Chief Investment Officer, is going to do the setup for the item.
Yeah,
Mr. Stout.
I appreciate that. I think you both have done a great job setting it up. So my remarks will be fairly straightforward and simple. So I just want to remind the corporate board kind of where we are in the timeline of all the decisions that need to be made. And then finally kind of conclude with the recommendation of maintaining the constitutional maximum 5G distribution. So on the next slide, that yellow mark is exactly where we are today. And so it's the corporate board's responsibility to adopt this supplemental revenue distribution rate. And we are asking for a approval today. And in September, we will go in front of the State Board of Education and start discussing the 5A distribution. So this is an amazing opportunity for us to make a decision today and then get in front of the State Board of Education for them to make a decision in the future, later in the year, in November, finally, to adopt the 5A distribution rate. So on the next slide, Ms. Jones, I wanted to congratulate you all. It has been an exceptional year. So this is this is a chart that shows the historical contributions that we've received from the general land office. And that line across the horizontal axis is just showing the $600 million distribution that we are recommending today. And as you can see, over the last roughly 10 years, the contributions that we've received have been in excess of that maximum constitutional allowed amount. And so we feel very confident that the board can decide to recommend that distribution going forward, and the corporation will be able to satisfy that in the future. So therefore, on the next slide, you're going to recommend a $600 million distribution per year. As Chairman Maynard said, that's $1.2 billion for the upcoming fiscal year biennium. That represents the constitutional maximum allowed amount. It's supported by the historical contributions we've received from the GLO. And just as a reminder that the PSF Corporation is responsible for maintaining that distribution, regardless of the contributions.
Any questions? Mr. Higgins?
I do, thank you. So the, I guess slide 46, you have all the numbers in the bars. The amount in 26, 1 point something billion, that was received by PSF.
So Jennifer mentioned this. So on a continuous basis, every day, the general land office is giving us money. So that 2026 number is the fiscal year. So this is technically through July.
Okay,
We have to close in August, and it's projected to be about $1.5 billion.
okay. And you invest the remainder, I guess,
Yes.
900, and we can only distribute 600.
Correct. And I just want to remind everyone for work, those contributions are coming to us. They are continuously being reinvested every single day. So if we get, $1 million, $10 million, we are constantly reinvesting that in real time as those contributions come in.
Great, thank you.
Okay. Do we have a motion?
Chairman, if I may, under the Open Meetings Act, it's best practice for remote participants to have cameras on for votes.
If we can have cameras on.
I have a motion when we're ready.
Mr. Wright,
I move that the board approve an annual distribution in the amount of $600 million in each of the state fiscal years 2028 and 2029 from the PSF to the ASF. The corporation will transfer 1/12 of that amount from the PSF to the ASF monthly.
okay. Is there a second?
Second.
I have a motion and a second. Any further discussion? No discussion, no questions? Is there any objection to the motion? Hear no objection, motion carries. Congratulations, all right. So that is done. We have the 5G distribution and we've done the maximums. GLO, thank you, again, thank you for the good work that's been done over there and look forward to hearing more great things. All right, thank you. All right, we're gonna move to item number 6. So the operating budget of the Permanent School Fund Corporation, as was mentioned earlier in the meeting, comes entirely from the fund itself rather than from tax revenue. It's worth noting though that we think that this fund pays for its budget in about 3.5 days. So the fiscal year starts on September 1st, which will be Tuesday, September 1st. And this fund will have actually generated its operating budget for the year, for the biennium, isn't it? That's pretty good. For the year, by the end of the week. So that's pretty outstanding. However, the Constitution does require that our budget be appropriated by the legislature each biennium. And so the budget request is contained in a document called the Legislative Appropriations Request, or LAR, which is approved by this board. So Vice Chairman Brad Wright is Chairman of the Budget and Compensation Committee, and he will further introduce the item. And so, and by the way, Mr. Wright, he is Vice Chair of the board. He's Chairman of the committee. He's a member of this board. But all of those titles that he have are trumped by one other title, and it's called Dad. And today was first day of school for one of his kids, and the dad title took precedent. And so I told him that that's the right thing to do. And so he would rather be here, but he had that great duty that he has to perform back in Fort Worth. And so, Mr. Wright, you're on.
Thank you, Chairman Maynard. Appreciate the introduction to this. The LAR, as Chairman Maynard mentioned, is kind of the key budget process. We're looking at the 28-29 biennium, which will run September 1st, 2027 through August 31st, 2029. And like a lot of things, this process has started to get its sea legs and is pretty well mature under the leadership of Mike Meyer. And it's a multi-quarter buildup in the Budget and Compensation Committee. We've reviewed a few preliminary drafts, and then in the middle of July, Mike made a close to final draft available to the board, and offered up time for any clarification or sessions. So I think there's been a lot of background and process to understand what's here. But the headlines to me were encapsulated well by Stu's comments earlier, which is we have a focus on efficiency and maintaining a prudent budget, but we're also trying to deliver a modern world-class organization and one that is market oriented. And that's really been a build over the last several quarters. And I think the budget reflects that. And from a fiscal standpoint, the takeaway is that we have up to 16 basis points. That's what's allowed under statute, and we operate in less than 10 basis points on our sort of total cost load. And Mike can hit those numbers in detail, but I think that's meaningful and represents the fact that we are operating in a responsible manner. And so the last thing is the Budget and Compensation Committee have reviewed this. Our recommendation is that the board approve it. And so with that, I'll turn it over to Mike to go through the details.
Thank you, Chairman Wright. I also want to recognize Lucas Brandt, our budget manager, and John McGady, our director of external relations. They've been critical in developing these recommendations for you today. I'm very excited to be here to be with the fund. In addition to being a numbers guy, I have a long history with education, including teaching students from 11th grade through into their 60s. So I'm very engaged by the mission, very proud to be here with you today. To summarize, our recommendations for you total $128.8 million for the 2028-2029 biennium. That total is unchanged from what you saw previously. There's been a little bit of shifting between the fiscal years based on some additional scenario analysis. But some of the high points here, the request includes full-time equivalent caps of 115 in 2028 and 120 in 2029. We've included $4.5 million in incremental increases. Those are amounts above the baseline limit that have to go through the legislative process. We'll go through that detail shortly. We're not recommending any substantive rider changes, only some small technical adjustments. And our goal today is to obtain your approval to submit the LAR, which is due tomorrow. Few process updates, as Chairman Wright noted, in July, we distributed a detailed information packet on the semifinal LAR recommendations to the board and offered opportunities for questions and feedback. We've also briefed state government leadership offices. In that time, also since your May meeting, our baseline funding limit was approved as submitted. And you may have heard that the governor and legislative leadership issued the instructions along with the requirement for a 3% reduction. Just wanted to note that reduction applied to general revenue type funds and does not apply to the corporation since we generate our own operating dollars. However, we did take into account the focus on efficiency in developing the final recommendations. And as I mentioned, our LARs due tomorrow. This slide gives you a 5-year trend analysis and a high-level overview of what we propose requesting. The bar chart on the right, if you see the dark blue lines, those are the baseline request, and the light blue are the incremental funding asks that we proposed. You can see the 5-year trend there, steady growth over the period, and a 3.6% increase over the adjusted base for the 2026-27 biennium. There's a list of kind of the key components of the LAR, which I mentioned a few of previously, and won't go into detail with now, as you've seen all of these before. You've also seen previously the incremental funding asks. You may have heard these referred to as exceptional items, which is the legislative term. These are any amounts above the baseline limit that have to go through the legislative process. Again, I won't belabor the details here, as you've seen them all before. We did provide you a little bit more information in the breakout between the fiscal years, and then also some additional statistics on the internship program. This table gives you the full 5 years that will appear in the legislative appropriations request with the detail and the manner typically used with the Budget and Compensation Committee, so the operational buckets. I'll draw your attention to the bottom couple lines there. One update, our projected assets under management have, in the time since this deck was posted, we do have slightly updated figures there, but there were marginal changes only that don't affect the admin cost ratio that appears on the bottom line. I want to highlight that, as Chairman Wright mentioned, this is a place where we prize ourselves on our operating efficiency, and something where we took the leadership's guidance, the governor, lieutenant governor and speaker's guidance on maintaining efficiency and budgeting. You could see that reflected in our admin cost ratio, which is actually projected to decrease compared to the current biennium. I won't go through all of the appendix. There are two appendices. The first includes other LAR components, such as some of our key messages in the administrator statement, organizational chart, and some other descriptions of functional units. And then the second appendix is some additional supplementary information on how, including what you can expect out of the appropriations process. Those were all my planned comments. As I mentioned, we're here today asking for your approval to submit the LAR tomorrow.
Okay. Questions? Any questions? Okay. So we are about to take a vote, so if we can get cameras on, the as is required under the open meeting law. Okay, Mr. Wright, do we have a motion?
We do. I move that the board approve the legislative appropriations request framework for fiscal year 2028 and fiscal year 2029 as presented, and direct the CEO to finalize and submit the legislative appropriations request to the office of the governor and the legislative budget board.
Second. Okay, motion in a second. Okay, any further discussion? Any objection to the motion? Hear no objection, motion carries. So ordered. Okay, congratulations.
Thank you, members. And I meant to mention earlier, thank you, Chairman Wright and Chairman Mayor, for your leadership on this. It's been very effective in the last almost a year now. Really good this month.
So. Fire clerk. Been good having you aboard. We had lots of discussion over the other building, way back. So. Okay, our next item of business, we're gonna move on to item 7, is discussion and action regarding reappointment of fiduciary council. Section 5 of the board governance manual provides that the board has the discretion to consider and approve the appointment of fiduciary council. Section 5B3 of the governance manual addresses the CEO's role in the board selection of service providers such as fiduciary council. The CEO is charged with recommending the appointment of service providers to the board. So, Mr. Borden, do you have a recommendation regarding fiduciary council?
Yes, Mr. Chairman. I recommend the board renew the contract with Jackson Walker for Chuck Campbell to serve as fiduciary counsel for an additional term of 2 years through August of 2028. I'll offer a couple of supporting observations to that recommendation. Number one, we expect with certainty to have at least 2 new members of this board in the new year. And this board will be charged with making a decision on a global custodian over the course of the next year, which will be a heavy lift. For those 2 reasons, and the fact that Chuck has served admirably in this role for many years, the continuity over this period of transition, I think, would be warranted.
Go ahead and ask for a motion, and then we can further discuss. Mr. Wright, you have a motion?
We do. I move that the board renew the contract with Jackson Walker for Chuck Campbell to serve as fiduciary counsel for an additional 2-year term.
Second. Got a motion and a second. Any discussion? Yes, sir.
Bob or Chair, do either of you know the current term? Is this another 2-year? Is that what we've been doing, or?
Yes, sir. It's up this month.
Okay, Then the last time we did this was a 2-year.
Well, we haven't approved it every 2 years, but the agreement, Brianna probably knows less than we did. We've approved it every 2 years.
The last one was 2 years.
Yeah, it was one of those extension periods. It was originally 5 years plus 2 years. A lot of our contracts had 5 years plus 2 years extension, so we were in extension periods.
Okay. So we're doing another 2 years.
Yes, status quo, current term.
Understood. Thank you.
Was there a little bit of a difference in just in terms of when we operated as part of the agency versus corporation, that's a little bit different? The status of the permanent school fund as a government corporation versus being nested under TEA made that a little bit different?
It would, yes, sir. The SB 1232 gives us broad authority to enter into these types of contracts without the requirements of formal process that apply to other state agencies.
And in our recently approved board governance policy, we specifically state that this particular appointment is now, the responsibility of this corporation board.
Any other questions or comments? Are you ready to vote? If I can have cameras on. So, form you can have the camera off. Yeah. Is there any objection to the motion? Hear no objection, motion carries. I think Mr. Campbell did step out.
I can go get him.
Because you have the next item.
Okay.
Okay. Next two things we have are just a couple of discussion items. And so earlier this year, we began really to think about and discuss the standing meetings of this board. We kind of talked a lot about the current board structure as reflected the fact that we were sort of building the airplane while we were flying it. Hence that's why we had a policy and strategic planning committee. And Chuck, congratulations, sir.
Thank you.
It was close, but I mean,
We're gonna take your name tag out.
good enough. All right.
Congratulations, 2 more years of this.
2 more years. So hopefully, get those parking tickets worked off like your public service here before. So just kidding. Anyway, so we've accomplished a lot, and so I think that it stood to reason that there came a point that, for instance, that the policy strategic planning we were actually developing a lot of policy. I think that we've really developed those policies. Now we're kind of in a maintenance mode, and then I think that what the thought process is that we wanted to reconstitute that, and in the creation of a risk committee. A number of you on this board have kind of raised that, and we've had some discussions internally, and to provide a little bit more direct board interaction related to the oversight of the portfolio. And so at this time, I'm going to ask Lane Arnold, our chief counsel, to review the draft of the committee charters. And just to be clear, is that this is not an action item today. It says that our intent is to make that an action item in December. And keep in mind that our committee charters are part of our governance manual. And so it would come in December as an amendment to the governance manual. And then these new committees then would take effect beginning in 2027. So, Mr. Arnold.
Thank you, Mr. Chairman. If we move on the next slide, you did a nice job of teeing this up. What we've done is literally take the existing charters for budget and compensation, strategic planning and policy, combine those into a new charter or a new committee that we would call administration, and then stand up a third committee, which is also a new committee called portfolio risk. As you mentioned, we're here on the next slide just discussing. Here in August, we provided initial drafts of those documents in February. And in December, the idea is we would have board action to potentially adopt those. On the next slide is just a summary to the edits of those February drafts that have been made. There are not a ton of edits. We've added and clarified that legislation and litigation affecting the corporation would go through the administration committee. That would be reports to that committee. That committee would recommend the appointment, reappointment, or discharge of fiduciary counsel. And as it's no longer the quote policy committee, we've just clarified that the ethics policy would be owned by the audit and ethics committee. Worth noting, there are no changes proposed to that committee's charter. And we'd also clarify, and you see it in the first bullet point there below under portfolio risk, that the strategic asset allocation and the investment policy statement would go through the portfolio risk committee, not through the administration committee. The portfolio risk would also consider the 5A and the 5G and recommend those to the board and those frameworks. And then that committee would also recommend to the board the appointment, reappointment, or discharge of those 3 service providers listed: the custodian, performance measurement service, and general fund consultant. And of course, you know, we lawyers can't help ourselves. So while we're at it, we do some wordsmithing. Following this in the materials is the actual red lines. We could spend as much or as little time as it pleases the board to do talking about those or wordsmithing those, or I will offer, of course, that we are here as a resource during the meeting, after the meeting, at any time now till December. I'm happy to connect with folks to receive comments and feedback and work through ideas and talk about those things. And with that, I'll pause.
Any questions? Nits and cleanups, nits.
That's probably not the best word choice for that. And nit is a
What is the literal meaning of a nit?
it's a baby gnat or a lice.
Lice,
Yeah,
exactly.
that's not good.
Yeah, that so we could literally say that term might maybe kind of bugs some people.
Yeah.
So.
Delousing the policies.
Okay, delousing the policies. Okay, questions for Lane or just any discussion, just in terms of members. We've seen this a little bit. We want to finalize this. You know, we don't. Any thoughts? Any suggestions? Maybe for additional changes. Okay. So you'll have some opportunity between now and then to kind of think through that noodle on that little. Okay. So, okay. If there's no further questions on that, we're gonna go ahead and close this item. And our next item is also Mr. Arnold. Section 4 of the Board Governance Manual adopted by this board this past December addresses board training. One of the challenges I think of this mandate is while there are certain trainings that are universal across all board members, things like governance and things like that. Certain training will be somewhat different for each board member depending on the experiences and expertise of each board member. And to that end, we have actually been building out a training library, and this is something that Mr. Arnold and I have been working on. We are going to create a very robust training library for the board. And so I'm going to ask Mr. Arnold to give us some color on that.
Thank you, Mr. Chairman. I am a little bit sad and upset with the timing of this. It's a good time to do it because the board governance manual requires training for new members within 90 days of having new members. But of course, that means we're losing some members, hence the sadness and the frustration. So preview of things to come at the next meeting, but we're losing 2 good board members. And so that's a little bit disappointing, but here we are with the training. So as mentioned, the governance manual does require not only the new member orientation, which we'll talk about in a second, but generally that board members should continue to develop and maintain knowledge. And so we're trying to help with that goal by creating something that sort of looks like, it's back to school season, right? So it's a good time to think about, of course, curriculum. And so we divvied that thing up into really 3 categories. There's a core curriculum, there are electives, and then there are certification opportunities. Members will probably recall that we recently did a board self-assessment, and many of the survey comments, we received good feedback that folks would like to receive training and education on various different topics. And so what we've come up with here will allow for individualized sort of course tracks on things that are interesting or perhaps not the everyday focus of particular members. We can help build out some of those topics and skill sets. There is actually a document, and it's in the materials, in the next slide, please, that is called a course catalog, and it breaks down the materials in 2 ways. First, there's the topics along the left-hand side. We have governance, endowment oversight, administration, and history and context of the PSF. And maybe it's a little too cheeky, but we even say like Gov 101 is going to be the ethics and fiduciary training. And so under the core courses that are required of all members, there are 10 of them, but that number is not as intimidating as it may seem. We're going to knock out half of those at the new member orientation, and we're going to extend that invitation to all members, not just new members. And then one of them we just knocked out with Aaron and NEPC, the discussion of the private equity and related asset classes. So there will be one of those at every regular board meeting. And then there's another one that will be, at least initially, maybe an in-person training, but we'll record that and then we'll offer that as a video on parliamentary procedure and Roberts and those sorts of things.
By the way, Aaron, K Cruz has agreed to do that, so.
And then along the other two columns here are just electives. What we've done in terms of electives, we've leveraged two things. One are sort of industry leading groups on corporate boards. And then the other one is free resources. A lot of good ones come from the big four accounting firms. And so, we can talk and we can plan the National Association of Corporate Directors, for example, has a pretty robust and pretty impressive certification if that's interesting to members. But that, it's going to take a lot of time. It'll take probably 2 years to complete that one. And on the other end of the spectrum, there's going to be one-off courses and articles and streaming opportunities for very discrete topics like cybersecurity or something like that. And then along the right-hand side, this is just our first crack at a list of certification opportunities that are available. And of course, the corporation will cover the cost of those and any travel that's required. There's some basic investment certifications, as well as I mentioned, some of the directorship certifications. And so really an opportunity there for directors to get creative and think about what they might want to focus on. That really concludes the prepared remarks. I can flash up on the screen, Jody, maybe 6 or 8 slides ahead, just to see what that catalog actually looks like. If you keep going. This is just the appendix here. Few more pages. And so this is what we talked about. Keep going, give me another page or two. So right here, so we list the core curriculum. There's a little summary of what the topic is and what that entails and when it would be offered. And for ones that are online, there's a link to the website. And so we can talk through and work through all of those options as folks have a chance to digest and think about where they might want some training.
Okay.
Essays on the final.
Say it again.
Essays on the final.
That's right. Essays on the final, and you cannot use AI for the essays.
Closed book.
Closed book.
Mr. Hickman, I would like to a little bit of a collaboration with you, a little bit on that new member orientation. You're one of the more recent, new members. And I just, we just want to make sure that we really thoroughly cover that and try to equip members the best we can, and give it our best effort, and make sure that when that new member gets to their first meeting, that, to the extent that we can, that they're, I don't want them to be lost, and because, they've got to function as a board member. We don't have a board member apprentice. I mean, they are a board member the day they get here, and they need to be able to have enough knowledge to function and to function effectively. And so, any thoughts from the board on what we're putting together here? Oh,
One question.
yep, yes, sir.
Yeah, appreciate all the work and structure put around this. So, a cool project. Just a question on implementation for the portion that's for new members. How will that apply to those of us who've already been on the board? Are we going to go over that at a specific time in the new year? Can you just kind of help us understand what the plan is?
I'm not sure we've decided that exactly what that's going to look like. We do know this is that we can't do anything until after the SBOE meeting at the end of January. And then we're going to be meeting, I think, the first week of March or something like that. And so we've got a little bit of a timeline, and I'm not sure that we've really decided that exactly yet, but certainly your input, everybody's input would be good. And I think though the thought process is that, you know, we would invite anybody who wants to come, if they want to sit in on that. And if nothing else is that, you know, sometimes having another current board member in there with a new board member that can kind of be part of the discussion and you know, and kind of give a little additional color around those kinds of things might actually be helpful, you know.
And I would just add to that, Mr. Chairman, we do intend to record those sessions. So if existing members can't make it to the new member orientation, we can share links to recordings. And you know, it might be good to, and so then that begs the question, if you have a quorum, do you have to notice it? Maybe, but we probably wouldn't broadcast it. It'd be just a work session. And, you know, we might want to do one of these live every year, like sort of ethics and whatever the topic of the day is. Spend, I don't know, a half hour before the regular meeting just to get some regular annual training outside of the videoed stuff.
Yeah, we are required to do ethics training annually.
Yes, sir, I believe so.
Okay, so we do need to do that at some point. And so, any thoughts from NEPC? I mean, y'all see a lot of boards.
Yeah, I mean, just initial takeaways, obviously, there's a lot more than just the investments there, so it was good to see kind of governance up top. I think that's probably more important than the investments at this point, because you have staff handling day-to-day investments. But yeah, we do a lot of education, and we're here to help, and I think you've maybe already chatted with Red on some of this stuff.
Yeah, I think we have you all in some of our 201 level classes and some of the 101.
Yeah. Chuck, you actually work for a number of boards.
Dude,
Yeah. What's your first thought here?
it looks great. Looks great. I think it's a good variety of topics and I like new members important, but then the continuing education is a pretty common piece as well. So.
Just so you know, is that the self-assessment that was done by the board is taken seriously. You know, it's not just a thing that we do and then we just you know, check the box and move on and ignore those things. Every comment that was written down in that self-assessment is all about, you know, process improvement, and it's taken very, very seriously. And so anyway, any further discussion, any thoughts?
Question.
Yes, sir.
I don't know if this is live now. If we're interested, do we reach out to Lane? We see a topic we want, or is this just going to be rolled out for?
No, this is yeah, we're working together. It's a work in progress. So reach out, please.
Yeah, it's available now. So if there's anything that you see on here that you want to do, it is, you know, we've been standing this thing up and we've been working on this. So yeah, you browse the catalog and, you know, and sign up. So,
If I may have hit Mr. Hickman, in particular yourself, we would welcome your hindsight, because you were the only new member that was kind of beta tested with what the best we had to offer at the time. And I'm sure you have a lot of like, it would have been good to know this up front as we develop this content.
Yeah, no, happy to. And I guess it's not too late for me. I can still get some training.
Absolutely.
Well, just looking to tell by my dumb questions, the investments is where I'll be focusing. So.
High expectations for your December meeting.
Right.
Yeah, we'll train by then. We'll give you some opportunity. Yeah, so, okay. Anything else? Playing good work on that and I think again, always continual improvement. Okay, we're gonna wrap up with just some committee reports. And so let's move on to item 10, report from the Budget and Compensation Committee. Chairman Wright, any updates? Budget and Comp Committee.
Yeah, thanks, Chairman Maynard. We've really covered the bulk of it with the LAR. We spent a little bit of time on the compensation, just progress on that plan, and then as well on the committee charters and but otherwise the bulk of it was on LAR, and we obviously just hit that in detail. So I think we're good.
Okay, thank you, sir. Thank you for your good work on them. Item number 11 is the Strategic Planning and Policy Committee. That is also includes the risk. Chairman Kinsey.
Thank you, Mr. Chairman. We met on August the 12th at 2:03 p.m. Two of the three of us were present. We began with remarks from Mr. Borden, the CEO. And then we start talking about the 5G supplemental distribution that we've covered today already. Start talking about risk management of endowment funds, 3L framework that we talked about earlier, as well as an emergency exit plan for a stagflation scenario. We received the reports from BNY and the portfolio performance, and we walked through the Q4 report in detail. We also started talking about the RFP for a custodial bank and performance measurement services, which will be starting soon. The current, just so everybody knows, the current contract is with BNY, and that contract's been extended through August of 2028. And so we've extended that one while the staff continues to look at the market in general and determine what the best course of action is for the corporation. With the draft committee charters, that's already been covered, as well as a fiduciary council reappointment. We received a strategic plan update from Needy. She stated the management approved an enhanced strategic planning framework to support execution of key initiatives while continuing progress toward the organization's 6 evergreen goals. Early results are evident that the AI initiative has achieved about 75% adoption, accelerated new use case development, and increased adoption by 88% since January 26 through the AI Champions Council. And finally, we looked at the proposed agenda, and then we adjourned.
Right. Any questions for Chairman Kinsey? And thank you for your leadership and good work on that. A lot of important work actually going on over there in that committee, and it's going to kind of emerge out into the new committee. But thank you for your good work on that. And finally, audit and ethics, Dr. Ellis.
Yes, thank you, Mr. Chairman. We met also on August 12th at noon. Our first item was the external auditor update. We had Mr. Riley and Mr. Kung from KPMG. They gave us status on the current year's audit of the corporation's financial statements for the year ending August 31st, 2026. We discussed audit context, and they will issue the audit report on December 15th, 2026. We then went into remarks of the CEO, much which were covered today. Our next item was Chief Audit Officer's remarks and update. We had Mr. Garza report on our risk control and self-assessment audits. And currently we have the business application change management audit was recently issued with an overall satisfactory rating. And he also discussed that the cash management and accounts payable risk control matrices were completed and no gaps were identified. We also discussed draft committee charters that we previously discussed here, reappointment of the fiduciary council as we previously discussed. We had Mr. Arnold give us a quarterly legal and compliance update. We discussed the periodic SEC filing processes are now improved and on track, and the team has now streamlined the timelines for completing the compliance and reporting. And next we have the cybersecurity update from the team. They presented an update on the organization's newly selected cybersecurity and AI awareness training vendor. They highlighted that the National Institute of Standards and Technology cybersecurity framework is in place. We also had a very interesting deep fake of our CEO, Mr. Borden, telling us to do something nefarious. I forget what it was, but it looked real. And so it's just very important work that cybersecurity team is doing. That concluded our meeting.
I have seen the deep fake. You should all see it. It's pretty amazing. Bob Borden is sitting there just, talking this like, it looks like a recording, but it's all AI generated. Any questions for Dr. Ellis? That robust audit process is so important to this organization, and thank you for that committee for the good work, and Fernando, all the good work that you're doing over there, Mr. Garza. So, okay. Last item, Mr. Borden, I think we get a preview of December. This is if there's a kind of reminds you of that song, "If We Make It Through December" by Merle Haggard, right? Everything's going to be all right, I know.
Thank you, Mr. Chairman. A couple of projected items. The projected December agenda you'll see in front of you for the known items. Of course, we can always have ad hoc items as they come up. Our next big presentation will be on the real estates and real assets portfolio. Very, very compelling and very interesting part of our portfolio that's been performing outstanding. We will have the heavy lift of approving the committee charters so we can hit 2027 running. And then, of course, in 2027, we'll have the election of officers and our public equities presentation. In the spirit of planning ahead and trying to keep things organized, we have drafted some proposed dates for the coming biennium. A key shift in moving this meeting to a September cadence. We find ourselves right at the end of summer vacations, beginning of school year. This is not the, optimal time really for, from a scheduling standpoint. So we're suggesting moving this meeting to the September timeframe. This cadence here very closely matches what the Permanent University Fund is doing as well. And also designed to be early enough in Q1 so as not to conflict with a variety of known spring break dates ahead of time. We will be asking for the board's approval for these dates in December. So if anyone else has any comments or suggested shifts, please share them with us along the way, and we'll put that up for a vote in December. I think before I close a point of parliamentary procedure, I'd just like to make an observation. And every day I'm humbled that this board has afforded me the opportunity to be the temporary steward of this storied fund. It's an incredible, exciting part in the 180-year history, and the work that we are doing here, I think, is going to really change the trajectory for the next 180 years. And I'm just humbled and grateful that the board entrusted me with that mission. And I'm deeply thankful for all of the members of my executive team that are seated at this table that has now been assembled over this last 2 years. I think all of you can recognize that the quality of content is improved dramatically. And I appreciate this executive team for, accepting the mission to join me in this endeavor. And just wanted to express my thanks to everybody.
Thank you for that. And any comments on the meeting dates? I guess my only question is then would we have to, would we need to move the approval of the LAR up into the June meeting if we push back into September? That would be a little bit of a change. And then what is the due date? 5G, when are we required to do that?
I'm not sure if we would need to move that to June also, but that would be part of the reporting we do to the Legislative Budget Board and the Governor's Office in around September.
Okay. Any other comments? Just as a point of personal privilege, we do have a visitor here in the room. Roy Hernandez, if you will stand up, Roy. Roy is studying finance at Ogden Community College. Graduated from a charter school up in Georgetown. Some of you who know, but he came here to watch the workings of a board of a major investment entity, and so he gets to see that for the first time. But Roy, thank you for coming. Well, so members, if we have no other, we have no other business before this board, and so we will stand adjourned. Yes.